Welcome to the Deep Dive. We're here to break down complex ideas and give you, well, really clear, actionable insights. Today, we're diving deep into dividend investing. It's a strategy lots of folks see as, a cornerstone for building wealth. Our main guide for this is Marc Lichtenfeld's book, Get Rich with Dividends. Really insightful stuff. Think of this as your fast track to understanding a really powerful financial strategy.
Exactly. And our mission really is to unpack why dividend stocks aren't just, a decent investment. Lichtenfeld actually calls them one of the most important gifts you can give to yourself or your children. That's pretty bold. We want to show you how they can genuinely lead to consistent wealth, financial independence, and maybe even deliver those headline numbers, 11% yields and 12% average annual returns over time.
Okay, so let's start right there. Why dividend stocks? Why are they always held up as maybe superior, especially compared to some of the riskier things people jump into? The book draws a sharp line, doesn't it, between speculating,
Yeah.
maybe getting lucky once in a while,
Yeah, fleeting look.
right, versus actually building wealth consistently with dividends that grow over time. The idea is that actual cash hitting your account, that's the sure thing.
That's such a critical point. Look, a company can get creative with its accounting, right? Or use buybacks to make earnings per share look better than they maybe are. But a dividend, that's cold, hard cash, leaving their bank, going into yours,
The
non-negotiable.
real transfer of wealth.
Precisely. It's a tangible litmus test, as the book says, of true profitability. It shows confidence not just in the past, but in future cash flow. Enough to keep paying, maybe even increase the payout. It forces a certain discipline on management, too. And history backs this up. Dividend payers tend to be less risky and more profitable. Experts like Dr. Jeremy Siegel at Wharton, they strongly support this view.
That focus on real cash, not just reported earnings, definitely resonates. And this brings us to why it matters for you listening right now. It means these stocks can potentially give you decent yields, even double-digit returns, when the market's flat or even down.
Yeah, you can sleep comfortably, even smiling, as Lichtenfeld puts it, during those scary bear markets.
Which is huge.
It really is. Especially when you think about, well, some of those worrying statistics about retirement savings. Like,
Right.
what is it, 60% of workers having less than $25,000 saved?
Yeah.
Dividend investing offers a practical way to tackle that reality, to build something more secure.
And the book doesn't just make the case for dividends, it also takes aim at some other common investment approaches, right?
Oh, definitely. It doesn't hold back. Technical analysis gets called throwing chicken bones and reading tea leaves.
Okay.
And quantitative investing, the super complex algorithms, they work great until they blow up spectacularly. Remember long-term capital management?
Vaguely, yeah.
Yeah.
Huge hedge fund.
Huge, $4.7 billion back in '98, supposedly fail-proof. It completely imploded.
Yeah.
And then there's growth investing, especially thinking back to the dot-com bubble. Remember e-toys, pets.com,
Huge hype.
massive hype, both gone within 18 months. The lesson Lichtenfeld hammers home is sustainability versus just chasing hype.
Right. So it's about real cash generation versus, I don't know, smoke and mirrors or
Yeah.
just predicting the future.
Exactly. Those other methods often rely on forecasts or, figures that can be massaged, dividends. They're about the fundamental ability to make and distribute real cash consistently. Think about Johnson & Johnson. Pretty boring compared to those dot-coms, right? But if you put, say, $3,000 into J&J, late 98 yield was only about 1.7% then, and you just reinvested those dividends, by late 2011, your $3,000 nearly tripled.
Seriously.
Yeah, it grew around 8.6% a year. And the S&P 500 over that exact same period, it returned a measly 2% annually.
Wow. Okay, that J&J example really hits home. Makes you redefine boring investing.
It does. The steady, maybe less exciting path often wins the race.
So how does this whole compounding thing hold up against, everything else going on? Politics, global events, inflation.
Well, connecting it back, reinvesting dividends is shown as the surest way to create wealth. The book stresses it works, quote, no matter who is president, what happens in Europe, Iran, or the Middle East, unemployment, inflation.
That's quite a claim.
It is, but the historical data is pretty compelling. Since 1937, the broad market index, with dividends reinvested, made money in 67 out of 74 rolling 10-year periods. That's a 91% win rate.
Even through depressions and crises.
Even including periods tied to the Great Depression and the 2008-2009 meltdown. And here's something really interesting, how they do in downturns. A Babson College study found dividend stocks outperform non-dividend payers by 1 to 2% more per month in falling markets compared to rising ones.
So they offer a bit of cushion on the way down, too. That 91% win rate is, well, it's incredibly reassuring.
It speaks to resilience.
But what about inflation, that sort of silent killer of purchasing power? How do dividends stack up against that?
Yeah, critical question. Average U.S. inflation is around 3.4%. That cuts your buying power in half in 20 years. Think about college tuition.
Don't remind me.
Huh. Well, in 2011, public university tuition jumped 8.3%. That was 5.1% above the general inflation rate since 2006. So, sticking money in treasuries, yielding less than 2%. The book calls that a terrible bet.
Because you're losing ground.
You're losing ground. You can't really compound that tiny interest effectively. But with dividend stocks, especially ones that grow their payouts, you have that potential for compounding to actually outpace inflation over time.
Okay, the power of dividends is clear.
Yeah.
But finding the right ones, that's the key, right? The book talks about perpetual dividend raisers. What are those exactly?
Yeah, that's the core concept. These are simply companies with a proven track record, a history of consistently increasing their annual dividend payout year after year.
Okay.
And there are various lists that track these companies. You've probably heard of the dividend aristocrats. They're in the S&P 500, 25 plus years of raising dividends.
Right, the big names.
Then you have dividend champions, also 25 plus years. Dividend achievers and contenders are in the 10 to 24 year range. And dividend challengers are the newer ones, 5 to 9 years.
So different tiers based on how long they've been raising payouts.
Exactly. The key isn't memorizing the lists, it's understanding that commitment to consistently increasing the cash return to shareholders. That's the signal you're looking for.
That makes sense. Look for the pattern. And it sounds like maybe individual investors have a bit of an advantage here sometimes.
Potentially, yes. The book points out you can find great little companies with long dividend growth histories that are just too small for the big institutional funds to bother with. Like Tompkins Financial Corp, solid history, but only a $451 million market cap back then. Too small for the giants.
Interesting. But are there trade-offs between, say, a champion with a super long history and a challenger that's newer?
Definitely. First, you have to be aware of survivorship bias. The lists only show the winners, right?
Oh, okay.
Like F&B Corp had an amazing 35-year streak of dividend increases, but then they cut it in 2009. Poof, off the list. So history isn't a perfect guarantee.
You still need to look under the hood.
Absolutely. And regarding yield versus growth, there's often an inverse relationship. Back in late 2011, the champions averaged about a 2.94% yield, but grew dividends around 7.24% annually. Challengers. Higher starting yield at 3.36% and faster growth at nearly 11%.
So the newer ones might offer more growth potential, while the established ones offer maybe more stability.
That's generally the trade-off, yeah. You have to decide what fits your goals.
Okay, let's get into the psychology a bit.
Yeah.
Why does a company bother raising its dividend? It's not just charity, right? What's the signal?
Right. It's definitely not charity. Raising a dividend is a powerful sign of financial health and confidence from management. It tells the market, we have plenty of cash for our goals, and we expect to generate enough next year to raise it again.
That's a strong message. Stronger than, say, buying back stock.
Much stronger, arguably. Share buybacks can manipulate earnings per share, make things look good, and they're just authorizations management can decide not to follow through. Remember Jarden. Executives got big stock grants tied to EPS targets that buybacks help them hit.
Yeah.
And acquisitions. So many are just boneheaded flops, as the book says.
Like the Snapple disaster.
Exactly. Quaker Oats paid $1.7 billion for Snapple, sold it 3 years later for $300 million. Ouch.
Yeah, ouch.
A consistent dividend policy, though, tends to attract the right shareholders, investors who are rational, thinking long-term, not just looking for a quick pop.
Like Eaton Vance. Grew their dividend every year since 1980.
Perfect example. And over 25 years, they crushed the S&P 500 by almost 6,000%. It shows management is focused on generating and returning real cash consistently.
And that consistency helps keep shareholders happy, maybe keeps those activist investors away.
That's part of it, too. Happy long-term shareholders tend to support existing management. Plus, think about the signal during tough times. If a company raises its dividend, even when earnings are a bit disappointing, the message is, okay, things aren't that bad. Our core strategy is working. We can weather this.
Reinforces the long-term view.
Exactly. It reinforces that whole idea that boring, low-beta stocks outperform over the long term. It's the opposite of the casino mentality, chasing the next big thing. And look, professional fund managers often underperform the market anyway. That 1984-2003 study, stock funds returned 9.3%, the S&P 500 did 12.2%, and investors jumping in and out often make it even worse.
So for your own portfolio, this steady approach means you can, as the book puts it, kind of snooze your way to millions. Maybe not overnight, but consistently.
That's the idea. A 10% or 15% annual return might not sound sexy compared to some wild flames, but over decades, it's incredibly powerful.
Like that Procter & Gamble example. $10,000 in 1981.
With dividends reinvested, could have turned into around $582,725 by the end of 2011.
Wow. And the yield on your original $10K would be like 84%.
Crazy, right? It also shows why a weak market can actually be good for long-term dividend reinvestors. You're buying more shares at cheaper prices, accelerating the compounding.
It really shifts your mindset about market dips.
Totally. And it makes those long-term goals feel achievable. Turning $100,000 into $1 million with a 13% average annual return, that takes about 19 years. Steady wins the race.
Okay, so we've got the core strategy. Compounding dividends, finding those consistent perpetual dividend raisers. But what about listeners who are comfortable with that and maybe want more? More yield, maybe ways to boost returns. The book dives into some more advanced stuff too, right?
It absolutely does. For those looking beyond basic stocks, it explores several specialized investment vehicles, things like closed-end funds, CEFs, real estate investment trusts, REITs, business development corporations, BDCs, master limited partnerships, MLPs, and preferred stock.
Okay, that's a list. Let's unpack those a bit. What makes them different?
Sure. Let's start with closed-end funds, CEFs. Now, these are different from mutual funds. They trade on exchanges like stocks, so their price is driven by supply and demand, not just the value of what they hold their net asset value, or NEV.
Meaning they can trade for more or less than their assets are actually worth.
Exactly. You can buy them at a discount, like getting $1 in assets for $0.90, as the book puts it, or sometimes at a premium.
Interesting.
And some CEFs have return of capital distributions. This is key. It's tax deferred. It lowers your cost basis instead of being taxed immediately as income.
Okay, tax angle there. What about REITs? Real estate investment trusts.
Right. REITs own and operate real estate. Think shopping malls, apartments, office buildings. They have to distribute most of their profits to shareholders by law.
Which means high yields, usually.
Often, yes. But the downside is those dividends are typically taxed as ordinary income, which is a higher rate for many people, though sometimes a part can be return of capital. And of course, they're tied to the ups and downs of the real estate market.
Makes sense. Okay, BDCs. Business development corporations. Sounds a bit like private equity.
Sort of like publicly traded private equity, yeah. They lend money or invest in usually small or mid-sized companies. Again, they have to pass through at least 90% of their profits, leading to high yields.
But higher risk, too, presumably. Lending to smaller companies.
Generally, yes. The rule of thumb holds. The higher the yield, the higher the risk. You really need to research the consistency of their dividends. Taxes depend on where the BDC's income comes from, interest, capital gains, etc.
Okay, two more. MLPs and preferred stock. What's the deal with MLPs? Master limited partnerships.
MLPs, often in the energy sector like pipelines, have a unique structure. They avoid corporate taxes. Almost all profits flow directly to shareholders, they call them unit holders, as distributions. And crucially, these distributions are usually treated as tax-deferred return of capital. So if you buy a 25-deal unit and get $1 per year in distributions for 10 years, your cost basis drops to $15. You don't pay tax until you sell.
Ah, deferring the tax. Interesting. Examples were like Kinder Morgan, enterprise product.
Exactly, but they can be less stable than your rock-solid dividend growth stocks.
Got it. And finally, preferred stock. Sounds like a mix.
It is sort of a hybrid between stocks and bonds. They usually pay a fixed dividend, so no growth there, and are issued at a set par value. In bankruptcy, preferred shareholders get paid after bondholders, but before common stockholders. They can be volatile, though. Remember how financial preferreds got hammered in 2008?
Right. So for all of these CEFs, REITs, BDCs, MLPs, preferred's the tax situation sounds complicated.
Extremely. This is not something to guess on. The book stresses, and we have to stress, you absolutely must talk to your tax professional before investing in these. Understand how they fit your specific situation.
Okay, vital warning there. Now, shifting gears slightly, the book also mentions a way to potentially turbocharge returns on the dividend stocks you already own, using options, specifically covered calls. Can you walk us through that? Let's start basic. Puts and calls.
Sure. A put option gives the buyer the right, but not the obligation, to sell a stock at a certain price by a certain date. A call option gives the buyer the right to buy a stock at a certain price by a certain date.
Okay, so what's a covered call?
Covered means you actually own the underlying stock at least 100 shares. So you own 100 shares of, say, J&J. You then sell a call option against those shares. Someone pays you a premium for that option.
Okay, so you get cash up front, the premium. What happens next?
Two mere outcomes. If J&J's stock price stays below the option strike price by the expiration date, the option expires worthless. You keep the premium you collected, pocketing extra income.
Nice. And if the stock goes up?
If the stock price goes above the strike price, the buyer of the call will likely exercise their right to buy your shares at that strike price. Your shares get called away. You still keep the premium, plus you profit from the stock rising to the strike price, but you no longer own the shares.
So you miss out on any further upside above the strike price, and you lose the shares.
Exactly, which is why the book notes it's generally more suitable for investors focused on generating current income rather than long-term wealth building through reinvestment. Getting your shares called away interrupts that compounding magic.
Right. Interrupts the snowball effect.
Yeah,
Makes sense. Factors like time left and volatility affect the premium you get.
absolutely. Options closer to the current price at the money, with more time until expiration, or on more volatile stocks generally command higher premiums.
Okay, that's a good overview of covered calls. Now, let's zoom back out a bit. Diversification and thinking globally, how does that fit into this dividend strategy?
Oh, it's crucial. Same old wisdom. Don't put all your eggs in one basket. Diversify across different types of assets, yes, but also within your stocks. Mix small, mid, large caps, and definitely include both U.S. and international stocks.
Why international specifically?
Well, sometimes foreign markets zig when the U.S. market zags. The book gives that wild example of 2008. S&P 500 down 37%, but the Tunisian stock market was up 10%.
Wow, okay. Extreme example, but point taken.
It just shows different markets move differently. Now, with foreign dividend stocks, yields can be attractive, but you need to be aware of currency fluctuations. They can make the dividends feel lumpy.
Meaning the amount you actually receive in dollars can vary.
Exactly. The Chilean bank example, Corbanca S.A., they paid more in pesos, but because the peso strengthened against the dollar, U.S. holders of the ADR, American Depository Receipt, actually received less in dollar terms.
Ah, the currency risk. What about taxes on foreign dividends?
Yeah, that's another layer. Foreign governments often withhold taxes. Spain, for example, might take 19% off a Telefonica dividend right away.
So you get taxed twice.
Potentially, but usually not. The U.S. generally provides a foreign tax credit. You file IRS Form 1116 to claim it, effectively offsetting the foreign tax against your U.S. tax liability. But again, check the specifics, maybe with a tax pro.
Good advice. Okay, we've covered a lot of ground. The why, the how, the different vehicles, even options and global aspects. Let's bring it all home with the core blueprint from the book, the 10-11-12 system. What's the goal here?
This is really the practical application framework. The goal is ambitious but specific. Build a portfolio designed to potentially generate an 11% yield on your initial investment within 10 years and achieve an average 12% annual total return over those 10 years.
11% yield and 12% total return. Okay, but these are guidelines, right? Not ironclad guarantees.
Absolutely. Think of it as a roadmap, not rigid rules. It's designed to guide you in building a portfolio that generates increasing amounts of annual income and creates real wealth over the years.
So what are the key signposts on this map? The criteria.
There are three main ones to look for in potential stocks. One, yield. You want a decent starting point. The target is 4.7% or higher. Two, dividend growth rate. This is crucial for hitting that future yield target. Aim for companies averaging 10% dividend growth per year. Three, payout ratio, safety. You need to ensure the dividend is sustainable. The target is a payout ratio below 75%.
Okay, 4.7% starting yield, 10% dividend growth, under 75% payout ratio. And there's an assumption about stock price growth too.
Yeah, the model assumes the stock price itself appreciates around 7.48% per year, which is roughly the historical market average since 1961. The dividend growth and reinvestment really drive those higher total return and yield on cost figures.
Got it. Now, you mentioned payout ratio for safety. Let's zero in on that. The book says just dividing dividends by net income isn't always the best way.
Right. That's a huge insight. While the basic formula uses net income earnings, the book strongly argues it's more accurate and safer to calculate the payout ratio using free cash flow or cash flow from operations.
Why the difference?
Because, as we discussed, earnings can be, and often are, manipulated. Accounting rules allow for flexibility, but cash flow, actual cash coming in and going out, that's harder to fudge. Gives you a much clearer picture of whether the company can actually afford the dividend.
So free cash flow is a better stress test for the dividend. Is there an example where this made a difference?
A classic one from the book is Vulcan Materials. Leading up to their dividend cut in 2009, if you just looked at their payout ratio based on net income or even cash flow from operations, it looked okay. Manageable.
Seems safe.
Yeah. But if you calculated the payout ratio using free cash flow, that's cash flow, after accounting for capital expenditures needed to maintain the business, it hit 100% back in 2006. Then 80% in 2007.
Wow, years earlier.
Years earlier, that was a major red flag, a clear warning that the dividend was becoming unsustainable well before the cut actually happened. Free cash flow told the real story.
Okay, that really highlights the importance of looking at cash flow, not just earnings. So using this system, when should you consider selling a stock? What if they cut the dividend?
The guidance there is pretty blunt. If a company cuts the dividend, the recommendation is sell, period.
Why so definitive?
Because the entire premise, the fundamental reason you likely invested in that stock using this strategy, the expectation of ever-increasing income no longer exists. The company broke the implicit promise.
Okay, cut means sell. What if they just keep it flat, don't raise it 1 year?
That's considered not quite as cut and dried. It needs more investigation. Why did they pause? Is it temporary? Is the underlying business still strong? It requires a judgment call based on the specific situation.
Got it. And one last practical thing. DRPs, dividend reinvestment plans, convenient, but any downsides?
They are convenient, yes. Your dividends automatically buy more shares, often commission-free. The main potential downside mentioned is if you have a diversified portfolio with, say, 20 stocks.
Yeah.
Managing 20 separate DRP accounts directly with each company can be a huge administrative headache compared to just having them all in one brokerage account where reinvestment is usually simple.
More paperwork.
A lot more. The real benefit of a DRP is if the company offers a discount on the reinvested shares, like Aqua America offering a 5% discount that's basically free money, boosting your returns. Otherwise, a brokerage is often easier.
Okay, that makes sense. So pulling this all together, what does this framework mean for someone listening, thinking about their path to financial independence?
We've really dug deep today into dividend investing, haven't we? Especially focusing on finding those perpetual dividend raisers and applying something like the 10, 11, 12 system. It really seems like a fundamental shift towards consistency, tangible returns, and just harnessing that power of compounding over time.
It really is. It's a strategy that's built not just for accumulating wealth on paper, but for enabling you, as Lichtenfeld puts it, to live a rich life pursuing dreams and interests. The goal is to reach a point where you're not constantly worrying about retirement or funding college or buying that first house. The dividends provide the income stream.
That's a powerful vision, and the book leaves us with a pretty provocative challenge, doesn't it? Imagine yourself 20 years from now. If you really put these methods to work starting today, what dream that seems impossible now might actually be within reach then? It's a really compelling thought exercise, isn't it? The numbers and the history provide the evidence, but actually applying it, building that future, that's entirely up to you. It's about starting the journey. Start getting rich with dividends.